So my paper was called Privatize the Methods and Publicize the Results. So a little bit about myself. I'm Jamal Thomas. I'm a Navy veteran, also a college student. I moved to California in 2023 and joined California Common Ground, which is an advocacy organization to try to bring land value tax to the Golden State, as well as reform our existing property tax system. I found Georgism in 2022 with doing my own little research. And after finding out a lot more about it, I was very interested, but I have a tendency of trying to find fatal flaws for certain things, and I wasn't able to find it for Georgism, and I ended up being here. So and then a little about myself that's related to Georgism. I grew up in the same state that the Fairhope Community Land Trust was established, which was in Fairhope, Alabama. So the main idea of my paper is to try to find something that could be created that could move Georgism along and have some type of either product or service that shows that our methods work. And I say that only because I see that we've had a lot of failures in the long history that we've had. And one of the reasons I think one of those failures keeps persisting is from Henry George himself. The fundamental law of political economy is that people have a tendency of trying to get the most by doing the least, or that people get set in their ways. And we can see this throughout the entire history of Georgism, or just land value taxation in general, is that once we get some type of progress, it always gets clawed back by rent seekers or people that are just benefiting from the status quo. And it's just a tendency for people to reward short-term goals rather than long-term success. So below, I actually put 4 different eras that we could draw from to show how long and how tough the battle has been for us. One of them being the Fiesocrats with Francois Quesnay and their political economy that influenced our founding fathers into trying to get land tax into the United States in the early colonies. One of the big conversations actually regarding the transition from the Articles of Confederation to the U.S. Constitution was whether or not land would be the main way of generating resources. However, as it always is, it seems, a lot of the landowners at the time didn't like the fact that they would be the main reason that they would be getting taxed. So they found ways around it. And if you move on from the founding fathers to the original Georgists of Henry George and other individuals of that movement, we see that this was also some of the main concerns of Georgism in general. And I put in my paper of the book, The Corruption of Economics by the late Mason Gaffney, that showed that some of the people during that time may or may not have just changed the definitions and made it intentionally hard for people to actually find Georgism and actually accept their political economy. But I would be remiss if I didn't also say that modern Georgism and our current interpretation does have some success. We do have land value taxation in places like Estonia and Australia, and as well as we have certain areas in the United States that are looking at it, like looking at Detroit, as well as if you expand the definition of taxation of natural resources to include severance taxes, places like Texas and Alaska have been doing it for decades. But I think one of the main problems we have can be summed up in a quote that I used in my paper from Benjamin Franklin, which I'm going to read in full here. "I have not lost any of the principles of political economy you have once possessed me of. But to get the bad customs of the country changed and new ones, though better introduced, it is necessary first to remove the prejudices of the people, enlighten their ignorance, and convince them that their interests will be promoted by the proposed change. And this is not the work of a day. Our legislators are all landholders, and they are not yet persuaded that all taxes are finally paid by the land, and therefore we have been forced into the mode of indirect taxes, i.e. in duties on importation of goods." And I truly just see that this one paragraph encapsulates hundreds of years of struggle we've had in trying to reduce our economy, is that the people that have all the influence and power aren't going to give it up without a fight. So what my problem solution is to that is that we create a banking structure that entices people to use their land value or have the land value taken away from them in exchange for products and services they want to get otherwise. And there's three areas that we're going to talk about and try to implement this. One is changing the banking system from an interest-based banking to an equity-based banking. Second is changing the reserve ratios from a fractional reserve ratio to a full reserve ratio. And then third is changing the banking operations to something that is more of a national corporate approach to more of a community banking approach that prioritizes long-term growth instead of short-term growth. So we're going to be talking about this throughout the entire lecture here, but each of these points are just going to be explained a little bit further. So we'll start with the good example of a bank that's doing actually pretty well. So Northrop Grumman Federal Credit Union is a credit union that's tied to Northrop Grumman, which is a very large military contractor. And they have a quarterly report they give to all of their members that I actually had a hold of and actually put into my paper. And when you look at the financial statement, it actually looks pretty good. They have $1.81 billion in assets and around $160 million in equity in other companies, as well as $24 million in liquidity of just free cash on hand if they needed it, as well as that the total return on investment for all their investments is around 1%. And if you took a cursory view at their page currently, these are all the interest rates for their flagship products of equity, home equity lines of credits and savings and loans. So by all respects, this is actually a pretty good credit union. However, we have certain things that we have to take account of with any bank that is based in interest and fractional reserve. And let's say if we had the first scenario where they put all their eggs into one basket, so to speak, and they ended up having a company or a market-specific slowdown. So say, for the example we had was Silicon Valley Bank in the paper that put a lot of their money into short-term treasury bonds. So when the interest rate hike happens, they were not mitigating their interest rate risk, which caused them to essentially shut down because of that. Now, good banks do have very good risk mitigation. However, it's still a risk that you have to have for every single loan and every single product you give out. And that's something that Northrop Grumman would have to account for. Second would be a market-wide recession. So if we had a 2008 recession or a global slowdown or any economic shock that affects all the companies on their balance sheet, there's really no real way for this bank to actually mitigate for that, but they still have to correct for that in all their products and services, which is why they have to have like certain reserve ratios, as well as they have certain things they have to prepare against, like long-term risk. So the third scenario that I put was funding problems. So because of the Federal Deposit Insurance Corporation, there is a $250,000 insurance limit that the federal government will insure any person that deposits into a bank. Now, this is a good thing for customers, but it's actually a kind of a bad thing for a bank because no one is going to want to invest above $250,000 because they don't want to have the inherent risk of them losing their shirt, vice the federal government coming in and saving their assets like they did with Silicon Valley and First Republic Bank. So one of the ways that the banks try to mitigate this risk is that they try to do this with interest rate manipulation, where they increase the amount of interest they get for their savings or their checking accounts or the certificate of deposits, on the off chance that somebody sees their interest rates and says, I'm going to become a new customer here, and try to get that person to get $250,000 out of them. And then they just rinse and repeat. So it becomes this kind of a rat race where every single bank tries to increase their interest rates high enough to attract customers, while at the same time keeping their interest rates on all of their products high enough in order to get the spread between the interest rate they're giving out to the customers and the interest rate to get off for their products high enough. So it's going to be equity banking, vice interest banking, full reserve, vice fractional reserve, and community banking, vice corporate banking. Next slide. And then this is when I was talking about Northrop Grumman Credit Union and their assets under management. Next slide. And this is just a cursory glance at their financial products. Next slide. And this was the 3 scenarios that showed how the current banking system is still susceptible to risks, even with all the different things they try to mitigate it with. Next slide. Okay, so this is something I haven't talked about yet. How would we fund this bank that's going to be based on equity and land value taxation, as well as all the other tenets of Georgism? And one of the different solutions that I thought would be pretty relevant is the FIRE movement's investment strategy. Now, the FIRE movement is the Financial Independence Retirement Early movement. But in a nutshell, this is a movement of people that want to retire earlier than 60 and 70. And the goal is to just take all of the money that they get in their high-paying jobs and put a vast majority of it into financial products called exchange-traded funds. Now, exchange-traded funds are financial products that allow for someone to buy fractional amounts of a certain stocks or bonds that are tied to a certain benchmark. So an example would be if you bought an ETF of an S&P 500 index, what you really are buying is a fractional amount of every single stock on the S&P 500 that is weighted based on what's called market capitalization, which is, in a nutshell, just how well the bank is doing or how well the company is doing or bond is doing or what have you. So one share in an S&P 500 index ETF is essentially just a fractional amount of every single company on S&P 500. So one of the ways you can make this into an investment fund, in the way that FIRE investment does it, is that they take all of these ETFs and they try to get one that is benchmarked to the entire United States stock market, the entire United States bond market, and maybe the international bond and stock market that is outside of the United States. So the way that the bond and the original fund would be created is can be done with 3 factors or 3 portfolio model. So in the paper, I discussed that you could take 3 funds, one of them tracking the entire United States stock market, one of them tracking the entire United States bond market, and one of them tracking the largest foreign stocks. And you can do this through the Vanguard, which is an investment company, and make a small fund. And the basic principles of this could just give you the yearly revenue you would need to run a bank or any wealth fund for that matter. Next slide. So one of the ways you can make sure that you have a steady flow of income throughout all possible scenarios is by taking your rate of return and subtracting whatever event could decrease the amount of funding that you have. So in this scenario, if we took an ETF that had 3 funds, one of them tracking the entire United States stock market, one of them tracking the entire United States bond market, one of them tracking the largest global non-US stocks in the world, and we had a conservative return on investment of 8%. If we were to subtract a 2% inflation that we get from the target that the Federal Reserve takes out, we would end up with 6%. Then we would also take out 1% for a negative dollar cost averaging. Now, what dollar cost averaging is an investment strategy where you take a fixed amount of money and you buy an asset on the market, and you do it on a regular basis. So say if you had $100 and you bought the same stock every single month, what dollar cost averaging is going to do is allow you to buy more of that stock when it's cheap and then less of that stock when it is higher in value. So if people have heard the saying, you buy low and sell high, you're doing one half of that by dollar cost averaging. Now, what negative dollar cost averaging is that since you're withdrawing your money regularly instead of trying to time the market, there's going to be periods in time where your assets are going to be pretty low. So a classic example is if you were trying to cash out your money after the 2008 stock market crash, you would probably be out a large amount of money. So what negative dollar cost averaging does is take a little bit of money and keep it into your investment fund on the off occasion that the, say, January 1st that you withdraw your money, there might be times that the assets are not as high as they were, say, the year before. And going with that, you also take 1% off for market volatility, just to make sure that, say, if you had wild swings in the market, that there could be times that you could have tried to withdraw on a period in time where there's like a shock or some type of epistemic failure of the market. So you're going to put 1% of withdrawal on that, just to make sure that if it happens, you've accounted for it. And then for the last percent, the margin of error, that's just to make sure that if you have, say, higher inflation that we do now, or if you had a period in time where it was 2008 and you withdrew all your money and you had an extremely large dollar cost averaging percentage, that's just to make sure that you would account for that. So if you account for your inflation, negative dollar cost averaging, market volatility, and margin of error, what this says is that you can take 3% out of your investment fund. And not only would you be able to get that 3% every single year without draining your fund to zero, but also you would be able to take 3% per year forever while increasing the amount of money in your investment fund. Next slide. Yep. So one of the things that I put in the paper was that I use Portfolio Analyzer, which is a very good way of analyzing stocks and bonds, as a way of trying to visualize how this would work. So I did another simulation here where I took a fund that had $10,000 starting fund, and I took a withdrawal of 3% at a frequency of 1 year that rebalanced every single month, so that the percentages stay the same. And I modeled what would happen if I started in 1974 and simply just held that money in that market from 1974 to 2024. Next slide. So on top is what I'm going to call the Bank Sovereign Wealth Fund, that has the three funds that we were talking about earlier: the stock market, the bond market, and the highest foreign stocks. And then on the bottom is the benchmark that we're going to use. In this case, it's going to be the very standard 60-40 split that a lot of investments advisors give you regarding how to allocate your money. Next slide. So after doing this analysis, you'll see that the starting and ending balance of the Bank Sovereign Wealth Fund is slightly higher than what you would have with the benchmark of the 60-40 stock bond split, as well as the fact that you would have an annualized return that is a little bit higher than the stock bond split, but the cost of it being that your Sharpe ratio, which is generally a measure of the amount of risk that you're taking, is going to be a little bit lower than it would be on the 60-40 split, as well as the Sortino ratio, which is also roughly a measure of the amount of risk-weighted return that you're going to have. Next slide. So this is a graph of what the amount inflation adjusted value that you would have from 1988 to 2004. And you would see that generally they kind of move back and forth with each other, but our sovereign wealth fund has a generally higher value during most times. But as you see at 2002 to 2004, it had less money than our benchmark. But now from 2020 to 2024, it actually started catching up and diverging from our benchmark. Next slide, please. And this would be the annual returns that we would have. Now, you also can see that even when you factor in all the different stock market downturns and recessions we've had, mainly the dot-com boom in the 2000s, as well as the 2008 stock market crash, and you can also see the very small stock market crash we had in 1990, as well as the pandemic stock market crash when we raised interest rates. There is still an annualized return that is higher than the amount of times we've had down years. Next slide. So, and this is eventually what we're leading up to, is that our annual withdrawals, even with the recessions and even with all the market corrections from 1987 to 2023, still increase. But as you still can see, during those stock market turns, we have our annual withdrawal lower by a certain amount because of the depreciation and a negative dollar cost averaging I was talking about before. So this more or less gives you strong evidence to show that if we had a sovereign wealth fund for the bank that was created with nothing but ETFs that generally track the United States stock and bond market and a little bit of the international market, that we would have a yearly passive income that we could use for our operations. Next slide. So with that, we're going to split the bank sovereign wealth fund into three parts. One of them is going to be our citizens dividend, which is going to be money that's going to be given equally to all of our bank customers. One of them is going to be our savings, which is going to be given proportionally to every single customer, depending on how much they put into their savings account. And then 1% is going to be put into administration costs. So essentially, just things that we need in order to keep the bank running, say the transportation, or say some of the other fees associated with transferring money from bank to bank and whatnot. Next slide. So now that we've created a yearly income that deals with some of our core services, we still need to have monthly income streams. And since we're trying to base this bank on equity rather than interest, the three ways that I put in the paper that we could do this is through personal income share agreements, which we'll be talking about later, land value sharing agreements, which is kind of the main tenet that we're also going to be talking about later, that's going to be rolled into our mortgages, as well as profit sharing agreements with businesses. So with these three, we touch majority of all of the income and revenue concerns we have without actually having to go through any of the rigmarole that interest has. Next slide. So now we're going to start talking about the individual checking accounts and how they would be set up. So the checking dividend, as I said earlier, was going to be split up to simulate a universal basic income for our customers. And one of the reasons for that is, one is that if it's funded through land value, which is most likely going to be for our mortgages, it's going to be a citizen dividend that's going to create that positive feedback loop that we hear about in all of our research papers, and we know that would happen if we started funding our public services through land value. Second is that the checking accounts are not going to be limited by the FDIC limits, because we're using a full reserve banking instead of fractional reserve banking. So one of the things that I was going to talk about later was the Chicago plan, and how this would be kind of a model of how the Chicago plan would work in real life, because of the fact that we are not going to be creating loans out of thin air, and all of our loans are going to be based on our assets that we have at the bank instead of otherwise. But in short, right now, what we would say is your checking account money is going to be your money, and it's not going to be touched by the bank for any reason other than in putting more money into there through our basic income that we're going to be giving you. So you can put whatever amount of money you want in that checking account, and it's going to be completely safe because it's not going to be touched unless you move it to do something with it, or you're enticed to put that money into your savings account, which is going to invite the risk of investment loss. But because of that, 100% of the money that you have in your checking account is going to be having the same protection as it would with FDIC without the limit. And also, this also goes into personal loans. So since we are not using interest in this bank, our personal loans could be funded through our basic income that we get. So say that you had in the paper, I said someone wanted a $10,000 loan and we got a $1,000 checking account dividend. We can simply just give them the $10,000, 0% interest, and then they just not get their checking account dividend for the next 10 months because of the fact that all of the money that is going into the checking dividend is taken out of the yearly bank sovereign wealth fund withdrawal rate, and instead of the monthly revenue stream. So we can pay them as fast as slow as they want, and it won't affect any of the banking operations. So this would be a night and day difference from what you would have, say, if you went to your local bank and they would probably charge somewhere between 6 and 8, depending on your credit score, percent on a personal loan. But at this bank, you would get 0 simply because of the fact that that money is already entitled to you. You're just simply just getting it faster or slower, depending on how you want it. Next slide. So as I was saying earlier, the savings account gets 1% of the bank sovereign wealth fund. And then it's going to be given out proportionally according to the amount invested. So this is going to try to entice the people that have large amounts of money in their checking account to put into their savings account and invite the risks along with it, because they're going to get a proportional amount of money that they put into it out of it. So I have a tiny little hypothetical pie chart saying that if we had customers that had large amounts of money, they wanted to sit here and put into our local community, say consumer E would get far more back because he put far more in rather than say consumer A, B, and C, and D. Next slide. So business loans are going to be profit sharing, and there's some precedence of this happening in other areas. The only difference between the other financial instruments that they are being discussed and ours is that we're not going to be restricting it based on religious preferences. But in essentially what this would be is just a profit sharing agreement where, say, the bank, instead of getting a $10,000 business loan and being told to pay back the principal and interest, with the expectation that if they make the minimum payment, they would pay far more interest than if they just paid it off completely under an equity-based financial structure. The money that the bank will get as a profit, and therefore, I wouldn't call it interest because it's not being compounded, but the profit that you're going to get for each loan, it's going to be done at the start of the bank creation. So the maximum and minimum amount of profit that the bank is going to get from every single loan is already going to be determined beforehand, so they can pay it off depending on how much profit that the bank gets. And it's going to be based on how much revenue or profit that the business makes. So say if the business is something like a local ice cream parlor and they make, say, like a 2% profit margin on all of their things, and they got a business loan from us that would necessitate them to give us like 0.1% of the profit, then that kind of aligns the success of the business with the success of the bank, because in the event that this ice cream parlor goes under or this goes through a time of instability, the bank is not going to get paid. As simple as that. So this is simply just a way of making sure that the bank and the businesses are always going to be on the same page. Now, I say this to say that there are going to be some instances that might have some businesses try to game the system, saying that, oh, we've made no profits and we've made zero this and zero that, and they're out here buying something they shouldn't have, or manipulating the books to make it look like they're not making any money. And if that's the case, you can simply just change to the debt-based structure of principal and compounding interest rather than the equity-based structure. But I think the first way of doing it would be much more advantageous to the average business. Next slide. So for student loans, this was actually a pretty interesting one. So a lot of the products that I thought that student loans would need to be given or be created were already being made and already in use. So income sharing agreements are a type of a student loan where is essentially a payroll deduction. So after they get their degree and they go out into the world to try to get their job, they a certain percentage of the amount of money that they make in their paycheck every single month is just simply deducted and given to the lender. So this is already done, much larger scale than anywhere else in Australia and the UK. And I had a paper that was discussing that from Kelvin Carey in the U.S. Should adopt income-based loans now, where it has a lot more benefits than we have in our current American student loan structure, in that there's no risk of default because of the fact that there's a cutoff rate, generally the federal poverty line, or when your income reaches zero, where you're not entitled to pay any money back. And the difference between the SAVE program that the Biden administration has and the income sharing agreement that these other countries have is that it's automatic. They simply just track whatever job you have, and they'll know when you lose your job, and you don't have to inform anyone, as well as the fact that it is a meritocracy. So if you get a six-figure job straight out of college, you pay off this loan much faster than, say, if you get the $30,000 job and you stay there for like 10 or 15 years. Now, one of the different ideas I had about this in general is that this is actually a very good financial product for things that have a very high startup cost. And one of the big industries or areas where this happens a lot is worker cooperatives. They have a very difficult time raising money because of the way that their company is structured, of everyone being a part owner. So since student loans are just simply a giant upfront cost that is just paid back through payroll deductions, you could have a lot of worker cooperatives be some of your main customers, because they can just simply get everything they need through the student loan, or in this case, it would just be a business loan structured as a student loan. And then we can just simply be paid back as the bank through payroll deductions. So next slide. So home loans were the tricky one, because the 30-year fixed rate mortgage is a uniquely American product. There's close to no other industrialized nation that has so much subsidies for home loans. And the goal here is to try to put land taxes into the mortgage such that it would be competitive with the 30-year fixed rate mortgage. So the way that this could be done is that you have a situation where the bank pays the property tax, but the mortgage holder pays the land tax. So the example that I put in the paper is that if you had a $100,000 mortgage with 20% down, which would be $20,000, and they had say an amazing credit score, the estimated payment at today's interest rates and fees would be around $600, with part of that being the principal, part of that being the interest, and part of that being homeowners insurance. So Say in this scenario, the bank pays the property tax. So in Hawaii, it's 0.3%. So that'll just be $300. And then the mortgage owner pays the land tax, which would be $600. We would still be able to get a profit based on the differential between the property tax and the land tax. So in this scenario, we would be incentivized to give out home loans in areas that we know that the property tax is being depressed and the land tax is much higher than it. And then we would be disincentivized to give out home loans where the property tax would be much higher than what the land tax is. So if you did this and you recalculate it yearly to what the new land tax and property tax rates would be, you could have a much more competitive product for certain people looking for home loans without like giving them something that would kind of be off-putting. Other than the recalculation yearly, it could be something that could compete with the 30-year fixed rate mortgage. However, at the later of this seminar, as always the case, I found something better that we could probably also use, but now we'll be discussing that also. Next slide. So certificate of deposits were the only thing that kind of gave me a little bit of trouble, since certificate of deposits are essentially an agreement between a person at the bank and the bank that the bank will give you a higher interest rate if you keep your money here for a longer period of time and don't use it for anything. So since we're trying to move away from interest, I would say that maybe a good way of structuring a certificate of deposit in this case would be setting up goals that could be done where somebody allocates a certain amount of their checking deposit dividend to these certificate of deposits, and then leaves them alone, don't look at them, and then wait for that to collect up until eventually they reach their goal. So then they could use that for wherever they wanted to. So this essentially does the same thing as a certificate of deposit, but since all the money is going into the same bank sovereign wealth fund, it really is no real incentive to have a certificate of deposit, but if people want it, it's still there. Next slide. So now that we've took all of these different financial products and the funding structure, and we put it into this one little area, we have to see whether or not this is actually going to work or not. So one of the things that I say in the paper is that private equity has similar funding structures to what I'm talking about currently, in that they take a fractional percent of ownership in a company, and then they're therefore entitled to a certain amount of profits in that company, as well as a lot of religions, as I show on the earlier slide, have prohibitions on usury or interest and have similar products, as well as full reserve banking has been completely modeled and shown to work in different forms on the macroeconomic scale. In this case, it was the Chicago Plan, which was a New Deal banking reform that was almost implemented during the Great Depression. As well as we've also shown that the FIRE movement research is particularly sound in that they would give us an annual income we could work with. So I think one of the main benefits of going through all this trouble is that some of the other attempts of implementing land tax and full reserve banking and citizen dividend wouldn't have the same barriers in this product as it would in other areas, simply because this is a completely private company. You don't have to get any government approval other than the banking charter. And after doing all this research, I think this is honestly one of the main viable ways forward. If we go to the next slide. So a lot of these tendons seem to reinforce each other in a certain way that makes it seem as though that without all three of them, you would not have any of these things present. So if you didn't have the land tax, you would essentially have the citizen dividend and the full reserve banking. And as we know, when you don't tax people's economic rents, you're going to end up with what I call the rent equals paradise, where they can simply increase the price on something without any constraints, to a point where they take away all the increases in innovation or profits that you have. Now, if you do the land tax and the citizen dividend, but not full reserve banking, you end up in a place where you have interest bearing banks being able to control who and what industries actually make it and what goes to the dust. So places that have different government structures, like worker cooperatives that we taught earlier, and also industries that have extremely high startup costs but very low profit margins, say some areas that are outside of Silicon Valley, like agriculture or other different areas, then you end up in a situation where the banks are able to control the market much more than they are now. But if you don't have the citizens dividend, you end up with high wealth and income inequality, because all the economic rents are simply just going to be given to the people that are at the bank instead of collected through the entire community through the bank. So having all three of these I think is the only real viable way to make sure that you get a Georgia society started and continued. Next slide. So in this part of the paper, I discussed some of the other criticisms that someone could have of some of my solutions here. One of them is that it's a lot of moving parts, a lot of new things that a lot of people haven't attempted before, at least on U.S. soil. And also, banks are heavily regulated. There is a lot of bank capital requirements that would have to pass muster to the comptroller of the currency, as well as the Federal Reserve, in order to actually get something like this created. And also, we kind of run afoul of the thing we were talking about earlier, where people kind of just don't like change. So if they saw a bank that's doing all these weird things that they never seen before, they might actually resist it instead of actually taking a plunge and saying, why not? And one of the other things is that our movement is very small, considering the socialists and neocapital and neoclassical economics are much more popular than us. Trying to alienate the socialists by creating something in a banking structure, the same banking structure that they kind of have a foul taste of because of 2008 and all the other different things to happen, it might kind of create a schism that would make it hard for us to work for them in the future. And then the last thing I said is that, if someone doesn't like you, they're going to find creative ways to make sure that you suffer. So, maybe someone that really doesn't like Georgism could find something that I don't even know about that could, squash this thing before you even start it. So next slide. So in response to those, I think that experimenting with any type of solution is always the best option. Even though we do have a lot of different achievements in our movement, I also think that there needs to be some new decisions and new solutions that be put out there. And also for a bank that starts extremely small, so say in a small town or a very small city, don't go to the middle of New York City or in the middle of LA and say that you're going to up in banking from the bottom up. If you start extremely small, I feel like you would get a lot more progress than if you try to use the startup company approach and try to up in everything that's been before you. And also, I think the profits would speak for themselves. If we're not trying to do anything that doesn't have a profit margin, this entire bank is most likely going to be generating a substantial amount of profits depending on how it's operated. And I think that would be a good way of bringing people into the fold rather than trying to appeal to their better natures. And also, I also don't believe socialists should have control Georgia's actions and solutions. So in the event that some socialist networks hear about this and they start railing us or comparing us to neoclassical economics and all the other different things, I think that's just a pill you will have to swallow at a certain point, because these socialists are not going to ever agree with anything that we're going to be doing on this front. And also, the final thing is that it's harder to stop a benefit than a curse. So if this is implemented and then if shown to be extremely profitable and the people in the community are getting a basic income as well as they're getting financial products they can't get anywhere else, and someone comes in and saying that this is terrible and you need to stop this, I think it's going to be much harder for them to actually convince these individuals getting all these benefits to roll back and go back to poverty than it is if we were trying to start out and do everything all at once. Next slide. So a couple of corrections and modifications that I added after the paper was out is I went to the Existential Crisis is Georgist Paradigm Part of the Solution conference we had this summer. And I came back with a lot of different things that I thought would be good additions to this solution. One of them is making a hard community focus that I talked about earlier. One of the big things that we need to put in place here. Like there does not need to be a national bank of Georgism at any time currently. It needs to be, I mean, ideally you would go to say somewhere in Iowa and somewhere outside of Des Moines and set up shop in some rural area and then, just do all your work in the shadows somewhere, and also another thing that I realized at that conference is that one of the ways that you could reformulate your mortgage is that you could have your citizen dividend be part of the income requirements to that mortgage itself. And then you increased your land tax in the payments that you would have in proportion to how the citizen dividend is increased. So say that if it was $1,000 in our previous example, and then next year it went to $2,400, that extra $1,400 could be 100% applied to your land tax and your basically your mortgage without any noticeable increase in the amount of money that the person would have to pay. Now, yes, this is simply just a loop of money going from the banking wealth fund back into the banking wealth fund. But in the event that the individual with all this basic income instead uses it on themselves and increases their own income, it still would have the same effect in that you will be able to increase the land tax to, say, 85% of the rental value, or maybe even 90% of the rental value, without the citizen feeling some of the brunt of large payments that are out larger than what they would get with a 30-year fixed rate mortgage. And also in the part of the lecture when Dr. Nicholas Tiedemann was talking, he gave a very interesting approach as to finding the economic rental value of land. As probably everyone here has already known, the rental value of land is kind of a very difficult thing to calculate at times. But one of the different things that he said could possibly work is if you took a certain percentage of the sales price and multiplied it by the land tax, and then also applied it multiple times throughout, say, a year or a month or a week if you wanted to. So below I have an equation where if I took the sales price of whatever the home was and then took our tax rate and then divided it, by 12, which would just be the number of months, you could possibly get somewhere close to the economic rental value of land without having to go through all of the different assessment problems or solutions, that if you think of it that way, that we're currently going through trying to find that. And the final thing with this modification is that Dr. Tiedemann also talked about limited purpose banking. So I struggled to find what a bank that is full reserve would do for day-to-day operations. And I leaned a lot on the Chicago Plan Revisited, which was the modeling done by Dr. Michael Kumhoff regarding full reserve banking. However, a limited purpose banking which was done by Dr. Lawrence Kirchhoff, is a much more realistic explanation of how a full reserve banking would work after all the different changes are made. So there's a very good book called Jimmy Stewart is Dead, Ending the World's Ongoing Financial Plague with Limited Purpose Banking that I would recommend for anyone that wants to look into it. But in a nutshell, it would just be a pass-through mutual fund that would allow people to buy in and sell that mutual fund. And the mutual fund would be connected to a bank that would provide services to the customers. So next slide. So other things that I thought about is if you're going to make it a strictly community-focused bank, that you should also try to add your own currency because it gives you a lot more ability to control the economic activity of your community than just simply using the US dollar. So if you just allow small businesses to accept this local currency, not only would you be able to just directly control the economic activity, but also you could give your bank their kind of a little bit of emergency powers since you issue your own currency and also you create your own land value and also in some cases create your own central bank digital currencies. So a good example of this would be Berkshire's, which is a local currency on the Eastern Seaboard that's been pretty successful in this. Next slide. So people who are not aware, Berkshires are a local currency that is regulated by a small local banks in the Eastern Seaboard of the United States. And they have essentially just a pegged one-to-one currency that is only given to members of that community to use for different local products and services. Next slide. So this is from their YouTube page, but essentially they're not doing anything weird with their currency. It's simply just pegged one-to-one with US dollars. Next slide. And also during the pandemic, they took that time to create their own digital currency. So this is a Berkshire Bucks, which is a digital currency that's issued by the local bank that allows them to pay for products and services with their phone. Next slide. And is ubiquitous enough that it is on Google Play and Apple Store. So this would be actually an amazing template that could be used by our proposed bank because not only would it allow for us to, like I said before, control the economic activity, but also it would allow us to experiment with the nature of money itself. Next slide. So the last thing for corrections and modifications in this area is that after reading Limited Purpose Banking, I saw that another funding source you could create is if you made a regional mutual fund where the mutual fund is something that is given out to the stock market that anyone can buy into, that essentially just puts money into the bank's sovereign wealth fund that the bank can then use to fund our local businesses and products and services. So this would be a way for people that don't meet the residency requirements and also say don't have the amount of money to meet the income requirements could still contribute to the local bank. And also as a way to increase the amount of money that you get for your yearly dividend into the people's pockets. So that they could get more profits and whatnot. Next slide. So the final thing that I was going to add is after attending Sylvia Gasell's Beyond Capitalism and Socialism, I saw that if you had a local community bank that was equity-based and also had citizen dividend as well as land taxes, you could also experiment with demurrage, which is essentially just inflation on the money supply instead of the entire economy. So this would only be done in recessions or depressions, in my view, because I kind of believe in the assumption that John Maynard Keynes had about demurrage, in that if you had to choose between currency that has just economy-wide inflation and currency that just has inflation on the actual dollar, people are tending to sway towards the dollar rather than the demurrage currency. But I think that calculus flips when you have things like recessions or depressions in place. So say that we had this bank set up and it was in a small community. We could set up a situation where we had demurrage on our central bank digital currency, and then we also set it up on our local paper currency. And then we have kind of a natural experiment where we can see whether or not this economic predictions of Sylvia Gassel could actually work, as well as we would find out whether or not Henry George's approximations of a free economy would also work as well, because we would have all the tenets of Henry George as well as all the tenets of Sylvia Gassel into one community, and we could run a natural experiment where communities that do have the bank, communities that don't have the bank, and allow the research to fund itself. So next slide. So in conclusion, I know that I've probably said a lot of things that would probably make a lot of people a little bit angry about what direction this would go. But my only response to this is that the main goal of this bank is to convince the local government that this would be something that they would be willing to put their tax revenue in. And if that is the case, then this bank could then give over control of the bank to this local government. And then within the stroke of a pen, all of the different things that we have done would become public instead of private, and the ends would justify the means, because we would have one community that has all the tenets of Georgism and not any attempt of moving it.